and welcome. I am Piers Ridyard, CEO of decentralized finance protocol Radix, a public ledger entirely focused on bringing DeFi into the mainstream. This is our podcast, The DeFi Download, a show about decentralized finance and all things crypto, where we dive into the details of the projects, assets, and services that are powering the DeFi revolution. Today, I am joined by Hannes Gray, founder of Gro Protocol. Gro is a DeFi protocol that makes it easy to earn yield on your stablecoins. You can either use PWRD, a stablecoin with a large amount of collateral backing for protection, or Vault for leveraged yield within the DeFi ecosystem. Hannes, thank you so much for coming on the show.
Thanks, Piers. Thanks for having me.
So let's just start off with a very high level. What is Gro and how does it work?
Okay, so Gro's first product suite is two products, right? It's the leverage vault and then PWRD or powered, if you want to add in the vowels in between, powered savings, which is actually stablecoin. And the basic design of this is when we were at the initiation of Gro Protocol, we wanted to create a high yield savings account with deposit insurance. And so how do you do a deposit insurance in DeFi? If you leverage insurance pools, then that's a bit tricky because generally the cost of protection exceeds the yield. And so what powered savings, which is the protected product, does is to give you this, a high yield savings product with protection that uses risk tranching to build the protection. We can talk a bit more about that later, but basically the risk tranching protection is offered by the vault side, the leverage vault. And so the vault offers that protection and in return of doing so gets higher yield. And so you have this symbiotic relationship between two products, one with higher yield due to this risk leverage and one with lower yield, but with protection against many of the common failures within DeFi.
So it's a little bit securitization and tranching of bond yields, where you have you bring together a bunch of products, you have cash that emerges out of those products like mortgages, and then you have the first tranche, the second tranche, the third tranche.
Exactly.
You obviously have more tranches than this, but you're saying that the cash will always first flow to the powered product and make sure that that's the safer one. And then once that has been dealt with, then the other tranches get the rest of the yield, but that means that they take more risk as a result.
Exactly. Senior and junior tranche type of structure.
Senior and junior tranche. Okay. And so what was the reason that you felt that this was an important product, the powered stablecoin specifically was an important product?
So the backdrop, not way back then, but I guess a year ago is kind of way back then in DeFi land where everything runs at high speed. I was coming out of a mobile bank, Revolut, and was looking at the DeFi yield landscape. And there were lots of interesting opportunities for generating yield there. We had the DeFi summer with everything from traditional finance stack being redeveloped and reinvented on DeFi, but also vegetable games. So the whole spectrum of things happening in DeFi. But one thing which was in common between most of them was that they offered some pretty spectacular returns. Also the occasional hack and crash and exploit. And when you talk to people on normies or people on the street of hey, you should really look into DeFi, the common conception, and which is often true in an efficient market, is that when there are high yields, it's because there are also high risks, because the market is efficient and risk is priced into the yield, right? So if that's the case, how can we basically make the market more efficient and allow people to, if it isn't fully efficient yet, how can we make the market more efficient by offering up a lower risk option for those who don't want to take on the risk? You don't have to get 10, 15, 20% annualized yields if you're comparing with a normal bank account that has close to zero. And so someone coming from that context would be fine with lower, in DeFi terms, 5% annualized yield, but with a protection against risks that they're not yet used to. And so that was the human insight of why we started to build the low risk product, is to give this option for people coming into the space, not wanting to worry whether Tether is fully collateralized, going to blow up, or whether one of the underlying protocols has an exploit. And so what the low risk product does is indeed cover against those various risks of failure of the various stablecoins and then the various strategies that are generating the yield. So that someone coming from a bank account is like, okay, here's protection. It's not deposit protection protected by a central bank. It's using risk tranching, but it's on this kind of first loss basis where the high risk product takes the hits first and can handle multiple failures in the ecosystem without impacting the value of the low risk product.
Got it. Okay, so I'd be really interested to understand the question that comes to mind, and we'll come back to it because a bunch of stuff has to be explained first. Is why would the leveraged products pay essentially for the coverage of the lower risk products? So that's where my mind automatically goes to, is like, if my leverage products are producing a yield and part of that yield is going to the tranche above me, then why would I even bother to pay for that next tranche down when I can go straight out to the DeFi ecosystem if I'm a high risk guy and get that risk, that yield directly without having to pay for the lower tranche? So let's go on to the vault mechanism and just talk about the more leveraged product.
Sure. So in the same way that the risk is tranched in case of these various exotic failures, stablecoin failures, or protocol failures, the yield is also tranched. And so a portion of the yield that's being generated for the low risk tranche is forwarded over to the high risk tranche. And the portion of the yield that is given over to the high risk tranche is a function of the utilization, similar to interest rate curves on Aave or Compound.
You're gonna have to break that down a bit more.
Okay. All right. So basically, we have utilization of the protection, which is the amount of capital in the low risk product, the powered savings product, as a ratio of that in the high risk product, the leveraged vault. That's utilization ratio. So if it's as much in powered as there is in leveraged vault, we have 100% utilization, and zero if we have no powered assets, right? And we can't issue more of the low risk product than the high risk product, because then we wouldn't be able to protect the low risk product with a high risk product, right? And so as that utilization goes up, as the amount of powered relative to vault goes up, then we forward more and more yield over to the high risk side. So that, if you will, the cost of the protection becomes more expensive, the more people who are buying the protection.
Right.
And so if the utilization is very low, then the cost of protection is very cheap.
So your growth rate is limited, or is there is a balance between the two, right? So you need more powered buyers to come in for there to be more leveraged available, more leverage available for the leverage side.
Yep, that's right.
Okay. And so what how does the leverage side work? What's happening on the leverage side?
So it's important to note that the leverage here is not in the sense of borrowing assets and then leveraging up on assets. Mm-hmm. All the assets that are put inside the protocol, which is any of the three major stablecoins, DAI, USDC, and USDT, all those assets, whether coming from the high risk or the low risk side, are pooled in one place, mm-hmm. and then distributed across 7 different strategies. Mm-hmm. And those 7 different strategies all generate yield. Mm-hmm. And then as the yield from those strategies flows back into the system, they are then distributed as per this utilization ratio I mentioned before between the 2 products.
Right. And what kind of strategies does DeFi used?
So there are 3 key sources of yield, really, and all of them have their kind of TradFi counterparts. You have lending income, so from lending mm-hmm. protocols, mm-hmm. Which is the core of a normal bank P&L, right? Net interest margin, net interest income.
So something like Aave. So I've got USDC. I go and put it on Aave, and because USDC is in demand, generally speaking, in the DeFi ecosystem, I get like a 12% per annum yield on that. Exactly.
So in big protocols with over collateralized borrows for the other side of those who are paying for these yields, right? Okay. So that's one traditional source of income. The second one is market making income. So market mm-hmm. making in AMMs, mm-hmm. Which is then earning the swapping fees between the swaps inside the various AMM pools.
Right. So taking something like USDC and USDT and DAI and putting it into the curve Web3 pool, which allows people to trade between any of these stable coins without paying too much slippage. But because there's a large amount of that trading that's constantly occurring, the people who are providing liquidity to those pools are earning trading fees. And that's also coming back to your vault, because people deposit these stable coins with you, and then the vaults go and deposit them in market makers, and then they make the fees off that.
Exactly. Okay.
Okay.
So I would say those two are also the kind of 0 to 1 moments of DeFi, right?
Yep.
Lending and then trading and market making, and how they can happen in DeFi. And then the third pillar, which is also has its equivalent in a kind of mix of whether you call it equity or marketing spend for protocols, depending on how you see it in the TradFi world, which are various governance token incentives that are being offered by the very same protocols we just talked about on the lending and the market making side, are offering up governance tokens as additional incentives for control of these protocols in the future, or currently. And they're then sold for increased yield.
Mm-hmm. And Curve does this a lot as well, right? There's the Curve governance token that also comes out of that, right? Okay.
Yeah.
And you said there are 7 strategies. So what are the main projects, DeFi platforms that you guys are working with to distribute capital and get a yield?
So right now the highest allocation is to Aave and Compound as 2 protocols. We also have, and you can see the distribution across all the strategies very transparently in the system. So if you go to the DApp, you can see exactly allocation to which stablecoins, allocation to which strategies, and then how protocol exposure is overlaid across multiple strategies. Because one thing to consider as well, that to us, maintaining protection against failure of stablecoins and protocols means we need to have a systemic view of the exposure, not just on a strategy by strategy basis, but if there's compound in that strategy and compound in that strategy, we need to add up all that exposure to ensure that we're not overexposed, so that we can handle a failure of compound, let's say.
Right. Okay. And so in terms of like, let's deal with let's deal with like 2 different failure types. So I'm just going to read back to make sure I understand that. So there's an investor comes to your protocol, and they have to have one of several stable coins. So they have to have USDC or USDT or DAI. Do you guys support DAI as well?
Yep.
Yeah, USDT, USDC, DAI. And when I deposit that, I choose at that point whether I want the powered product, the protected yield product, or if I want the leverage product.
Yep.
Right. And then the assets themselves, they go into a pool for that is in common with both. It's not that It's not that there is a powered pool and a leverage pool. There's just a pool, and then you have the senior and the junior tranche of powered versus leveraged or vault. The protocol then goes and allocates those stable coins that it has to several different other DeFi applications that offer capital providers a yield, either for lending and borrowing or for market making, and also the extra of there being governance tokens coming out of some of these things that can also be sold. Now that capital comes back into the pool. Presumably gets traded into the stable coins that are represented in that pool. And then the shares are divvied out according to, first of all, the yield that is offered to the powered token, and then anything left over then goes to anyone who's in the leveraged side of it. So if you've got 3.61%, which is what you have at the moment, that goes first to the powered token holders, and then anything additional goes to the leverage guys.
Kind of. It's split basically. When the yield is generated, it's split to both sides based on utilization. Okay. So the primary thing that's being tranched is the risk of failure. So loss of principal, if you will, in case Tether blows up or something like that. And then the distribution of yield between the 2 sides happen as a function of this utilization. At that point in time, it's split into 2 sides.
So the yield changes on both depending on how much people are buying powered versus how much people are buying the leverage product. Okay, that makes sense. Now let's deal with some failure cases. Okay, so failure case number one, I mean, they're sort of the same actually, but let's just say that USDT completely blows up. Question before we go into that example, does your system automatically balance equally between each of the assets, regardless of what comes in? Is it always balancing equally, a third, a third, a third?
Yes, at the moment it does. It's also governance parameter, but right now it's set to a third each.
Okay, in the case that USDT blows up 33% of the value, let's just say it's gone. Let's just say that it's just completely gone. What happens then?
So if we exclude there's also an allocation inside an AMM, inside a curve, which creates more complex stablecoin exposure. But if we ignore that for a second, and let's say that there's a third of capital in the system that have blown up. And let's also, for sake of easy math, say that there's an equal amount of capital on the high-risk side, leveraged vault, and the low-risk side, powered savings. Yeah, so there's 50-50 distribution. Then instead of taking a third of each side's capital, we take 2/3 of the leveraged vault side's capital.
Right.
Nothing from the low-risk side.
Okay. And how does that actually get represented? Because so like, is my powered token essentially a rebasing asset?
It is. It is primarily a positively rebasing asset, yes.
Right. Okay, so every time I get yield, I'll see that represented as just more powered tokens. So the powered token's always 1-to-1.
Yep.
And is that the same on the other side as well?
The vault, because of the nature of this built-in protection, doesn't make sense to have it as a stable coin because it might change.
Right.
If there's
so it's just a standard LP percentage.
It's just a standard, called the GVT token, but
Okay. Called a what? Sorry.
Gro Vault Token.
A Gro Vault Token.
It is tokenized, so you can move the token around, but it's not a stablecoin token.
It's not a stablecoin token. Okay. And so my Gro Vault Token will essentially, I've got a pool that's worth 2/3 of what it was before.
That's right.
So you can take
one third in this case, right? Because you lost 2/3, 2%.
Sorry, 1/3. Beg your pardon. Yeah, 1/3. So you can essentially bear the absolute failure of 1.5 stable coins before powered token has a problem.
Yeah.
Okay.
It gets a little bit more complex because we also set aside some assets into a curve pool, and in an AMM you basically have full exposure to all 3 stables for each of the stables. So, but yeah. Right.
So your risk is actually higher as a result.
Yes. Right, but we take that into account when calculating exposures. So the protocol is aware of the additional stablecoin exposure coming from the curve exposure.
Okay. So you guys launched this. I mean, it sounds like you've launched this. Sorry. To answer my own question that I posed earlier, which was, why would the leveraged why would people even pay for the leverage side? And like for me, that seems to be clear that essentially because my yield's going to be more volatile. However, there's going to be a multiplication effect on my yield because only some of the yield goes to the powered token side, and the rest of it gets distributed to the capital to the vault side. And my vault capital is also being deployed into the strategy. So not only am I getting the default return that I would be on my vault tokens, I'm also getting extra from the powered side because I'm essentially the person who's covering their capital deposits, and I'm getting paid extra for that.
Yep. That's
very nice. Okay. All right. So how long ago did you guys launch?
About 3 months ago now was when the protocol launched. Yeah.
And how did that go?
So first off, we launched just the protocol without any governance token, just to make sure that the core engine was working. And yeah, that worked well. We launched. We thought we'd have more demand for the low risk side from normal retail users, but in DeFi, people are quite risk hungry. Mm-hmm. So we saw a lot of demand for the vault to begin with. And then we saw more and more interest for the low risk product for another type of stakeholder within DeFi. So treasuries is another stakeholder that has a different type of risk preference for the low risk product. And so that's something that we're now doubling down on, to basically powered savings becoming a bit more of a lowest product for institutionals. Think of it as a money market product, if you will.
Yeah.
And then we pretty quickly moved on to start building on the next big thing in innovation, which was one of the key things we wanted to bake into the original Vault, but we needed to have other building blocks in place first, which is even more aggressive, higher yielding strategies. Because right now we're offering, let's say 10 and 5% APY on the leverage Vault and the base, the powered savings product. But there are some more aggressive yields available on other places. So that's what we've been spending a lot of time and effort on recently in getting that together.
So what is current sort of like total value locked between the two?
So,
and then what's the utilization between the two?
Yeah, so right now we are at 67% utilization. So that's 67% powered to Vault, which means we have around 28 million on Vault and 19 million on powered. And then we also have another 57 million in our pools, which are like a staking program that we have, where you can lock down your assets together with other assets for other types of governance token incentives.
Interesting. And like, how did you guys find launching? I mean, 3 months ago, to now, obviously the yields that you're offering are to people outside of DeFi very attractive. To people inside DeFi, a little bit, like it's fine. But I'm not writing home about it inside DeFi, that being the insane space that it is. How did you guys find like pitching that quite nuanced selling point of the powered token and of the vaults, and like how did you get over that initial it's not 2000% APY, I'm not interested problem?
Yeah. So I think it's important to look at two parts of yield, right? There's base yield, where we think was base yield, and then there's governance incentive yield on top of that.
Mm-hmm.
And so base yields are in the range of, at best, like low double digit generally, mm-hmm. if you look at just stablecoin yields, and don't include volatile assets as part of the principle. So that was the first product we launched without a DAO. Then we launched a DAO, and we started offering the Gro DAO token, which is the governance token for Gro Protocol, on top of the base yields, which then has allowed us to actually offer those very high APYs. So now if you have the various pools, we have ranging from 50% single-sided on the governance token itself, up to 350% in a LP token between stablecoin and the governance token.
Interesting.
So there are those options as well for the ones who want to take on more risk as well, right? Because we also have pure stablecoin farming with Vault tokens. You can stake down your GVT tokens for currently 87% APY.
Okay, so let's dive into the governance token and just talk a bit about.
But I want to just make it clear here, like, so there are those things, right? There's base yield, and then there's the yield on top of that.
Yes.
And how can you optimize both of them independently and then in combination? Mm-hmm. So first we launched the base protocol for base yields. Mm-hmm. Then we launched the governance token layer on top of that, which optimizes the pool yield or the governance token yield. And now we're looping back to also optimize the base yield. And so being able to offer high double or even triple digit APYs without using governance tokens incentives top, just from base yield activities. So that's been the next core focus in improving and really creating mind-blowing stable APYs.
So how do you do that?
So that's the product we're launching tomorrow. The labs.
Amazing.
Product.
The what? Sorry, what's it called?
We call it the labs.
The labs.
So the labs.
Okay.
Yeah, there's a number of different labs labs inside the labs product section, which is basically doing. It's still leverage. It's going layer 2. It's partnering up with another protocol, and it's doing managed leverage position in LP with a volatile asset. So basically, we're borrowing a volatile asset, so AVAX, LPing that into AMMs, and then maintaining exposure to not be too long or too short versus that asset. So that allows us to do LP provision, which has pretty high APYs, but without a user having to also take on a big long or big short position on the other asset. Okay,
and so this is being launched tomorrow. And can you break that down a bit more for me? So, like, what is the A little bit more on how that actually works.
Sure. So first off, it's on Avalanche. So this is our first launch outside of Ethereum L1.
Nice, congratulations.
So low gas cost. Then and it's event compatible, so it's easy for us to also port assets between Ethereum L1 and AVAX. The products, there are 3 labs, one for each of the major stablecoins. So they're, unlike Vault and Power, they're not all stablecoins into one. There are separate labs for each of the stablecoins. You just deposit your stablecoin after you bridge it over to Avalanche.
Avalanche, yeah.
And then our strategy opens up a position by borrowing AVAX from Alpha Homora Bank, and then deposits the asset that you deposited together with the borrowed AVAX into an AMM on Avalanche, which then, similar to LPing on Curve or Uniswap, Sushi, offers, of course, trading fees. But in addition to that, also additional token incentives from the other protocol, which we can then compound into the position on an ongoing basis.
Got it. And how does the management of the position? Because obviously you've borrowed AVAX. How do you manage the volatility of that?
So this is the key question, right? And this is if you are LPing, you often see you end up with maybe a lot more of the asset or a lot less of the asset than you thought that you would when you started out, right? And so the manual way of doing that is to just continuously keep track of it, and then rebalancing your position manually, pulling out when prices have moved too much, and then topping up or selling off depending on if you are too long or too short. And then if you want, like, redepositing into LP position to continue to generate yield. What the protocol does, what the Gro Labs does for you, is to do that. Whenever the price moves outside of certain boundaries, then rebalancing to maintain market neutral exposure. So making sure that the exposure to AVAX is not too long or too short. And when it starts to head too much in one direction, then basically closing down, rebalancing, and reopening a position, which we had a great battle testing of during this weekend, when a lot of the market moved down very aggressively within a very short period of time. But despite that, our LP positions were healthily in profit, which is pretty cool.
That's very cool. So you're essentially trying to do this before the market trades against your position. So you're trying to you have to pull out. So let's say that you have a large price move, and I'm assuming this is just like a Uniswap V2 style AMM, where the ratio of the assets in the two pools give you the price.
Yep.
And if the market moves aggressively, this hasn't moved yet. What you're saying is you want to pull out your LP tokens, rebalance, and then push them back in, and then push the tokens back in at the right ratio before someone trades against that pool.
We're not trying to front run any of the trades. There are continuous trades happening all the time, right? And in fact, we're dependent on the trades to generate the swapping fees in the AMM, right?
Sure.
So it's not about front running them, but there's an assumption and expectation that there are continuous trades happening that generates that, and it's rather about cutting losses before the position is too long or too short of the borrowed asset. In this case, AVAX. So. Yeah, if you did manually, you end up very, very long or very short the borrowed asset as the market moves. But what the protocol does is basically cut it off within certain threshold boundaries to generate the equivalent of stablecoin yield, because you're just depositing stablecoins, right? But with the type of not the equivalent of LPing yields, but only using stablecoins. Normally, when you're LPing outside of a stable swap AMM like Curve, you usually also take on exposure to the non-stable asset like AVAX or ETH or whatever it might be.
Interesting. Okay, and so the from this you're able to deliver much higher returns because you're able to provide. Does that mean that the liquidity provider is also receiving some of the upside on the AVAX token as well, right?
No, because we are capping the exposure, right?
Right.
So whenever the market moves, we cut it off and go back to market neutral. So yeah, I mean, yeah.
Okay.
No, not really. Right now, the position is market neutral, but that's one. If there's an interest, you could also create like these kind of semi-managed position that maintains a relatively fixed but floating around the range, some X leverage or some X short or long exposure to the other assets.
Very interesting. And so, how does that interact with the Vault product and the powered product?
At the moment, it doesn't, because we have launched this first labs together with Alpha Homora on Avalanche, and so it's currently separate from that and just separate assets basically, and like an order of magnitude higher return on these products compared to the Vault and Power products.
Very interesting, and still give people the ability to gain that exposure on Ethereum, or that does the user have to bridge across, or do you guys bridge across on behalf of the user?
Good question. Because it's trustless, users have to bridge it over. Like all the products we built are trustless, as in users can withdraw their funds, and it's not that we are taking the funds and running a fund. It's a decentralized protocol, right? And so same thing with this. So users will have to bridge over the asset themselves to Avalanche and deposit into the different vaults, into the labs. Sorry.
Got it. I mean, you're saying it's not possible. I suppose it's not. Can't do the smart contract calls. Okay, interesting.
You could do like a buffering of assets, right? So that you have some like semaphore token that bridges over assets, but then some kind of trusted wallet would have to bridge the asset until you have like trustless communication between different protocols. You can do that now through like L2 bridges with arbiter norm optimism. You can do like trustless messaging, and there are a number of different messaging protocols being built. But I don't. As far as I'm aware, there's nothing in production yet that does trustless messaging between protocols.
Does this feel like a change in strategy for Gro overall, or does this just do you feel like you're responding to what you're seeing as actual market demand for your products is, or do you see a way in which this sort of like comes back around to the core of what you guys started, which was like, hey, we want to offer a savings product that's got protection against it, that has a relatively decent for normal mass market applications yield?
So the idea was always to have aggressive yield generating strategies also on the leveraged vault. Labs is meant as a staging ground where strategies that are working well can also then be voted in by the DAO into the main vault. But the main vault is meant to be in more stable, together with powered, of course, ongoing products, which you can then roll more aggressive yield generating strategies into them, but only after they've been tried out and working in the labs, right? So that allows us to have like continuity and consistency on the main products. But that doesn't mean that the labs product can't be standalone and work just as well without being in the vault, right?
Right.
So yeah.
Yeah, which was why I'm asking sort of like, is this a change in strategy, or is it is there a bigger picture part of this and how this sort of rolls back together and just means that you end up having a higher yielding powered product at the end of the day?
Yeah, so we can do this also in Ethereum mainnet. Of course, gas costs are a bit more interesting there. But we could also launch these strategies first labs on Ethereum mainnet, and then they could also be rolled into the vault if the DAO wants to.
Right. So let's talk about governance and the DAO. So just walk me through. You said that originally the core product was launched without a governance token. There is now a governance token. There's some liquidity incentives around it, and then there's a DAO. So just walk me through all of those different pieces.
Well, that's a lot of different pieces. So, I mean, we talked about two products, which is the core products, and now we talked about labs as well. But also in DeFi, the DAO could almost be considered a product in and of itself, right? Because there are many different collaborative workflows that you basically have to productize to make them work in a decentralized way. So from how the thing is set up, the distribution of the governance, as well as the ongoing operations of how governance can impact different parts of the protocol, whether they're softer parts like the broader direction and roadmap, or more tangible parts like this parameter on this strategy, should it be 1, 2, or 3? And so all those different work streams have to be to some degree think about as a product that you build that can interact with itself. And so we launched the DAO by letting the DAO launch itself. Basically, people who had used the protocol, they were giving a prototype token called XGRO, airdropped, which they could vote on whether they wanted to launch the Gro DAO and the governance token and how to do it. And so we ran emoji governance first in Discord, where people got to vote and say what they wanted to do with various things, which then got formalized into a form proposal. So we have community.groexocensus forum, and then we have voting, which we do through Snapshot. But what we also did with Snapshot was we integrated with Safe Snap. So we basically had a Gnosis Safe, where the transactions can be executed by Snapshot. And so inside the Snapshot vote, the transaction payload was put. And as the holder of the prototype token XGRO voted to execute the tokenomics and the distribution as per the forum post, that got executed on chain by the holders of this prototype token.
That's very cool.
So the DAO basically got to create itself, and all the key decisions around that, which then led to the formation of the DAO and the Gro DAO Token, which now can be used, of course, for voting, and not just held in wallet, but in LP positions, in our vesting contract, can be used to vote on various decisions. So we have like an aggregator contract that takes into account all the various Gro balances. But there was also, speaking of like problems to solve, another one is as you're offering up governance token, quite often it's perceived just as yield, and as a protocol we're also farming governance token and selling them for yield. But an interesting thing we're looking at there is how can we get governance of the protocol to be primarily concentrated into the hands of those who have a continued engagement with the protocol,
right,
as well as a more long-term view of the protocol, and not just those who are farming it just overnight, or not, at least not only to those. You want to ideally get the governance into the hands of those who have more engagement. And so that's the part of we talked about how the tokens can be used for voting on different things, but the way that they're also distributed is through a mechanic where whether you're earning these governance tokens through liquidity mining programs or airdrops or whatever it be, they're put inside a vesting contract. And you can claim your tokens at any point from this vesting contract. But if you do it ahead of schedule, which is a 1-year schedule, then you get whatever has been vested so far, and you forfeit the portion that hasn't vested into a vesting bonus pool.
Right.
And anyone who's still vesting, anyone who decides to stick around, they can go now it's every 28 days. They can go every 28 days and they can claim their pro rata share of that vesting bonus pool. So you get this kind of Squid Game-like mechanic where the people who leave are giving up a portion of their governance to those who stick around. And those who come back every 28 days and claim their share of the vesting bonus, they get a larger stake and a larger say in the protocol.
Right.
So
you're rewarding longevity, and you're also rewarding at least engagement from the point of view of every 30 days engaging in some format. And what kind of decisions did governments have to make in the system?
So the most recent thing that was up for vote was reviewing these tokenomics that I just talked about. So as an example, one thing that was asked for was, can we get more liquid Gro, which is the governance token, out into circulation for people who are liquidity mining? So the token, there's like a revised tokenomics proposal that was multiple DAO members proposed different angles to it, and then finally was aggregated to one tokenomics proposal, which was voted through with, I think, 92% voting for it. And by then, Snapshot, we have pretty high participation in terms of members who are following and joining the product, which is cool. So it seems like it's working to get people engaged in governance. And what this new tokenomics proposal does is that it allows you, when you're claiming your rewards, there are a number of different changes that was voted through there. But one of the things that the DAO requested and voted through was the ability to choose, when you're claiming your Gro tokens, whether you wanted to get 30% in your pocket now and 70% given back to the vesting bonus, or take the whole 100% and put it in your own vesting bonus, which gives a bifurcation of the path for those who actually want to be a bit more short-term. They can pocket 30% right now, but every time they do that, they give 70% to those who are more long-term. Or those who do want to be more long-term committed to the protocol, they can take 100%, put in the vesting contract and carry along. And in fact, those who do that, they get not only their own 100%, but also the 70% of those that go for the more short-term path.
Right. And what, like, so obviously you guys got a relatively interesting and mature governance system. What have you learned about governance in during this process? Like, how have you? What do you think are the good parts of it, and what do you think are the bits that still need sort of work?
Time takes longer. Things take longer when you're aligning a much larger stakeholder community, which kind of makes sense, right? It's not really rocket science, but that means you also need to bake it into the timelines and having the proper soliciting opinions and making sure that you integrate all the different ideas so that you have proposals that are truly the will of the DAO and not just some kind of formalization of a centralized opinion, but actually is the DAO's will, right? And that's why I say that the DAO is a product, is that you need to have a decentralization champion that just focuses on ensuring that the DAO's will is expressed, but also that the DAO is properly informed and can have not just knee-jerk short-term reactions to things, but can actually understand different complex matters. Because also our products are not necessarily, the value prop is like protected yield. That might be simple on a higher order basis, but then when you dive lower, try to understand like the risk balance or how the strategies work, it gets quite technical. And so figuring out how the DAO can be involved in these different parts and be sufficiently read up on it to be able to add value. That's a challenge that I think anyone who any DAO spends a lot of time and effort on making sure that is there.
How have you guys found tie breaking? Like in the case that you have two camps in your community that have strongly held and opposite views. How have you managed that process?
Yeah, that's a good one, right? So we had a vote recently where the options that were put up ended up being quite binary, as in yes, it could be a gradient, it could be like a range or an average of different responses, but the way that we structured the vote was in a more binary way. So either it happens or it doesn't happen. Which basically ends up making one group of stakeholders happy and the other one unhappy.
Right.
But you could structure the same kind of vote with options and do like a weighted average of those options, which means no one becomes really happy, no one becomes really sad, but everyone becomes kind of happy and kind of sad, right?
Plus complexity increases.
There's that. But I think that's so we had implemented in the way of like more binary vote. In retrospect, we should probably have done more of a range and then use that. But at the same time, if you put up something for a vote and you think later you could have structured the vote differently, you can't really then sit up and you to say like, no, we can be nice in methodology and like override the will of the DAO, because the DAO was very clear in its opinion of those two binary votes, with like a 6 points lead on one side versus the other. So this goes back again to thinking through, okay, how are the votes structured? And we should probably also talk not just about the vote, the bigger topic, but also exactly how the different options for the vote are structured, to make sure that, okay, everyone understands what they're voting for and what will be the outcome of the weighted average or the binary options, etc. So yeah,
it's such a fascinating area of like the DAO concept and how it sort of just represents the coordination problem, full stop, just at the level of social interaction rather than like network interaction. But it's still the same issue at the end of the day. How do you come to consensus?
Yeah.
And then once you've come to consensus, how do you then proceed from that point? Like it's just the next level of problem.
It's an age-old problem that's now getting replicated in a DAO network. It's just that in DAOs, your vote is the number of tokens you hold and not your existence as one singular human being. So it's more of a capitalist democracy, if you will.
It's a plutocracy, right? Yeah. And which, has its own problems. But I mean, on that, it's been such a pleasure talking to you. Thank you so much for coming on the show. If people want to find out more about Gro, where do they go and what should they read first?
Go to Gro XYZ, join our Discord.
Just on that, for those who it's not GROW, it's GRO.XYZ.
That's true. Yeah, we had a typo in our protocol name there. GRO. Also, Gro whatever was already taken everywhere. But yeah, right. Gro, which is so the etymology for that. The Swedish word to grow, gro. I'm a Swede, right? So it means to grow in Swedish.
Okay, awesome. So you were like, hey, we're Swedish. We're going to go with Swedish. The world can learn Swedish. Okay, cool. So go to GRO.XYZ and then?
There you can both, of course, read about the products. You can also access the dApps from there. You can check out the new Labs product if you want to go multi-chain. And then our discord.gg/GRO, which is our the key hub for our DAO, and where we also do both a mix of internal, external, and everything communications on there.
Awesome. Hannes, thank you so much for coming on, and have a wonderful day.
Thanks for having me, Piers.